Julia, when I was a young airlines analyst, the holy grail that all planes wanted to be, or airlines wanted to be, was based in Asia, either in Hong Kong or in Singapore. You had the US to your right, you had Europe to your left, emerging middle-class travellers, you had lots of trade. But horrendous results today from Cathay Pacific, bizarrely. What's gone wrong?
Well, exactly. I mean, and Asia still is, the investment case is still there for Asia, but for Cathay Pacific, they've just been clobbered by rising fuel prices met with low demand. There's a couple of things that are specific really to Cathay, which is its exposure to freight.
They're the world's biggest freight mover,
exactly, and it's a quarter of revenues. So as fuel prices go up on that and demand goes down, it's already not a very profitable business anyway. That's just going to massively hurt their profits in that segment in particular.
So you've got fuel, you've got a problem with end demand for goods, I suppose. And what about hedging? Any mitigation there for that?
Well, this is it. I mean, they used to be quite aggressive in their hedging, but then they took big losses on that back in 2008. So they're not as aggressive as they used to be. So as a result, they haven't managed to benefit from that in this instance.
So cargo ugly. What about the passenger side?
Well, passenger side is doing okay. I mean, obviously the market is still not brilliant. Again, they're exposed there because their long-haul flights are a big component of their business, 55% of capacity. So they're still going to get clobbered in fuel in that area. But overall, they didn't do too badly. Their yields were up, their load factors were up because demand outpaced the growth in capacity. So they're ticking along in that area.
We saw from the Qantas results recently, especially on the international side, that they were being clobbered by new entrants from the Middle East. Is that a similar story with Cathay?
Not as much. I mean, Qantas definitely is getting clobbered by that. But I mean, for Cathay being based in Hong Kong, it's still the most popular Asian route, the Hong Kong-London, followed by Singapore-London. If anything, they're facing more competition from China, so take Air China. But then they have a fifth share in that company, so they benefit a little bit from that. And overall, the demand pickup in China should outpace any market share losses that go to companies such as Air China.
And Cathay made a loss today in its results, and the shares were off a fair bit. Are they looking attractive now from a valuation point of view?
They're getting that way. I mean, it might be that things get worse before they get better. Fuel prices are up, starting to go up again, going into the second half after a little kind of blip in May. So it doesn't look like the second half is going to be brilliant, although it should be better. But the minute the fuel price turns, then they're poised very well from that perspective.
Yeah, no, it's all about the fuel price for these ones, right? So yes, another story about the global downturn affecting company profits. Thank you very much for that, Julia.